Hey everyone, and welcome. Today we're going to break down one very specific part of the apparel world, off-price and value fashion retailers. This is the deal-first side of fashion. These are the businesses that help shoppers buy recognizable stuff for less, either by selling branded goods at a discount, which is the classic off-price model, or by selling lower-priced basics and private label goods, which is the broader value model. By the end of this video, you should understand what sits inside this block, how these retailers actually make money, who the customers are and why they come back, how this segment behaves across the economic cycle, what has changed in the last few years, and then the most important part, how this block could evolve over the next decade, including a few simple scenarios for what could go right or wrong. All right, let's start with what this block actually is. There are three key business models in value retail. First is off-price treasure hunt. Think constantly changing assortments where retailers source product from closeouts, canceled orders, and excess inventory, creating urgency and discovery. Second is value mass retail, where everyday low prices are paired with broad assortments, and apparel and footwear often act as major traffic drivers that pull shoppers into the store. Third is value and dollar chains, built around lower price points, smaller baskets, and more frequent trips. Customers pop in often for essentials and quick fill-in purchases. Together, these models win by matching price, convenience, and a clear reason to visit. The key behavior here is that the assortment changes fast. They keep the shelves feeling new all the time, so shoppers are trained to come back often. A leading operator markets a common value promise that's roughly 20% to 60% below full-price retailers' regular prices on comparable merchandise. That number is important because it sets the whole tone. Customers are not expecting a tiny discount. They're expecting a meaningful deal. Second, you have value-focused mass retailers, where apparel and footwear are meaningful categories. Think big box, discount department, or variety formats. For these businesses, apparel often acts as a major traffic driver. It helps get people into the store and adds items to the basket. They typically sell a mix of national brands and strong private label, and the product promise is good enough, cheap, and convenient. Third, you have value and dollar chains that carry apparel basics. Here, the basket tends to be smaller, the trips are more frequent, and the price points are lower. Apparel is often basics and seasonal items. Across all three, what they sell is pretty straightforward. Apparel, casual wear, kids, basics, seasonal, and footwear, casual shoes, seasonal footwear, basics. And many of them also sell adjacent categories that pull traffic, like accessories, beauty, and home, depending on the retailer. Now, who are the customers? The key point is these are value seekers across income levels. Off-price especially is not only low-income shoppers, it also attracts middle and higher-income shoppers who genuinely enjoy the find. People show up when they want a deal, a quick refresh, or honestly a little dopamine shopping without paying full price. In the sector value chain, this block sits downstream, right in front of the consumer. But off-price has a special role in the system. It monetizes the mistakes and the leftovers created upstream. Brands overproducing, retailers canceling orders, seasonal clearouts. In other words, it turns the messiness of fashion into a business model. And it connects to other blocks in a few clear ways. With global apparel brands and footwear brands, off-price acts like a pressure release valve for excess inventory. And it's also a pricing power test, because if too much product ends up in off-price channels, it can weaken the brand's ability to sell full price. With online and digital-first platforms, it competes for the same value shopper and increasingly for the same deal discovery behavior. And with textiles and manufacturing, it can indirectly change behavior upstream, because if brands believe they can clear later, that can influence ordering patterns and volatility. Before we go deeper, let's map the block with a few example listed companies. These are just illustrative examples to help you place names in the right box, not stock recommendations. On the off-price side, the TJX companies, NYSE TJX in the US, Ross Stores, NASDAQ ROST US, and Burlington Stores, NYSE BURL US. On the value mass retail side, Walmart, NYSE WMT US, and Target, NYSE TGT US. On the value and dollar side, Dollar Tree, NASDAQ DLTR US, Dollar General, NYSE DG US, Five Below, NASDAQ 5 US, Dollarama, TSX DOL Canada, and B&M European Value Retail, LSE BME UK/Europe. And the analysis also calls out two newer or emerging challengers in the value mission space. One is PDD Holdings, Temu, NASDAQ PDD, which is a China/global value challenger. The key idea is that Temu is mobile first, ultra low price, and built around a high velocity browsing loop. It's not off price in the classic sense, but it competes for the same shopper mission. I want something cheap and fun to browse. That can pull attention away from store-based treasure hunt trips, especially for younger users. The other is Savers Value Villages, NYSE SVV, in the US and Canada. The Rift isn't classic off-price either, but it competes on value plus uniqueness plus a sustainability story. And it can steal some treasure hunt demand because it offers the same emotional payoff. I found something cool for cheap. Okay, so now you know what this block is, who sits inside it, and where it fits in the value chain. Next, the natural question is, how do these businesses actually make money and what really drives their economics? That's what we'll cover now. Let's start with the two main business models. The first is the off-price model, which is the engine of this building block. The basic playbook is buy branded goods opportunistically, meaning closeouts, cancellations, and overproduction, and then sell them fast. A big part of how off-price creates repeat visits is that stores get refreshed several times a week. The point is to keep the assortment changing so the customer learns if you like something, you buy it now because it might be gone next time. And the competitive advantage here is not the prettiest brand story. It's being a better buyer than everyone else, better sourcing, better speed, better judgment. The second is the value mass retail model. Here, the goal is to sell basics and trend-light apparel at low prices using scale purchasing and private label. Apparel also plays a role in increasing store trips and baskets, often alongside groceries and household items. Now, where does capital get tied up? For most of this block, the number one tie-up is inventory, meaning working capital. They also tie up capital in the store footprint, leases, build-outs, fixtures. Then you have distribution and logistics, like DC networks and trucking. Then people, store labor, and importantly, experienced buyers and merchants. And finally, data and systems, forecasting, allocation, shrink control, pricing. The economic logic of off-price retail is a simple four-step loop. First, buy cheap enough. That's the procurement edge. Second, move inventory fast. Speed and sell-through matter. Third, avoid heavy markdowns because that's where fashion retailers lose money. And fourth, leverage fixed costs. Stores and distribution don't get much more expensive as volume rises, so higher throughput can lift margins. We have a useful proof point. A major off-price retailer delivered about 30% gross margin and over 11% pre-tax margin in a full year. That shows discounted goods can still generate strong profitability. But cost pressures are real. Shrink, wages, and payroll meaningfully affect margins. So what actually drives profits? 1. The deal pipeline. More brand overproduction means better supply and margins. 2. Consumer trade down. When budgets tighten, shoppers shift to value. 3. Cost shocks like freight, wages, and shrink. 4. Tariffs and trade policy, which can raise costs and pressure margins. And 5. Execution quality, buying well, allocating smartly, and running stores efficiently. It may look easy to enter, but it's hard to win at scale. The real barriers are access to deals, operational scale, and execution. And that sets up the next question, the customer, why they come and why they keep coming back. Let's start with the shopper mindset. Customers come in with different missions. Sometimes they need basics cheaply. Sometimes they want a brand look on a budget. And sometimes they're just browsing for fun. Off-price works because it serves both functional needs and emotional shopping. The treasure hunt experience matters. Stickiness comes from design. New inventory arrives several times a week. Assortments change fast, and that creates a habit of frequent visits. One major operator even reported comps driven mainly by higher transactions, meaning more trips, not just bigger baskets. Customers have lots of alternatives: other discount chains, big box stores, online marketplaces, and resale. So winners combine real value, fun discovery, and convenience. Macro matters too. When inflation is high or confidence is weak, shoppers trade down and hunt deals, which supports off-price. When incomes rise, that tailwind fades, but value doesn't disappear. Apparel is often postponed, not canceled, and off-price turns "I'll wait" into "I'll buy if the deal is good." What's changed in recent years? Value seeking became normal, not just cyclical. Costs like wages and shrink became major profit drivers. Digital raised the bar for what cheap means, and private label grew as a margin and control lever. Looking ahead, near term, value stays sticky, but costs stay challenging. Medium term, scale and execution matter more, and weaker players get squeezed. Long term, off-price remains structural because fashion always creates surplus. But systems, sourcing, and regulation will shape who wins. The takeaway is simple. This isn't cheap retail. It's a disciplined machine built on buying well, turning fast, and keeping customers coming back for the thrill of the next great deal.